Hey guys, I hope you all are doing well. Welcome to the next episode of the Logical Shorts. Today, we will be looking at a concept in Ind AS 37, that is the difference between provisions and accruals. So, provision as defined in Ind AS 37 is a liability of an uncertain amount or uncertain timing. So, what is a liability of an uncertain amount? Let us say a case has been filed on you, the entity. So, let us say you have a legal counsel who estimates the probable outflow that you will be incurring as an entity. Let us say the legal counsel is not able to say that X is the fixed amount that you might incur as an outflow in the future. So what the legal counsel would do is the legal counsel would say that the probability of X amount of outflow is 50%, the probability of Y amount of outflow is 30%, the probability of Z amount of outflow is 20%. So the legal counsel will not be able to zero in on a specific number and say that this is the fixed outflow that you will be incurring as a liability. Let us take another example for liability of uncertain timing. So in relation to Provident Fund, there was a court judgment called Vivekananda Vidya Mandir, wherein the items that had to be included for calculating the Provident Fund had been increased. So basically, all the fixed allowances had to be taken into account to compute the Provident Fund liability that had to be deposited. But many entities had not complied with these in the past, in the prior years. But as soon as this judgment came out, the entities created a provision in the books for the past years also, because on any day the PF authorities could demand the amount of PF liability in relation to the allowances, in relation to the amounts that had not been included earlier in the PF computation. But the question is when, since the date on which the PF authorities would demand the PF amount contribution from the entity is not determined, this is also a case where a provision would be created. And coming back to accruals, so accruals are liability for goods or services that have been received but the amount has not been paid as the terms have not been agreed on completely, or the invoice has not been received. So in case of accruals, let us take a very simple example. Let us say you are an entity and you have received electricity services for the month of March. So you will not be receiving the bill exactly on March 31, which is your book closure. So on March 31, you will basically be having a rough idea of the number of units you have consumed, and you will multiply that with the rate per unit that is roughly available and to the best of your knowledge, and you will arrive at the amount that is to be booked in your books of accounts. So in this case, you are creating an accrual because you have not received an invoice for the electricity bill, because the billing cycle may be different. The billing cycle may be on 7th of the next month or 6th of the next month. So this is a case of an accrual. You know the liability amount, it is just that due to administrative reasons you have not received an invoice. So coming to the presentation of both in the financial statements, your provisions will be separately present as provisions on the face of your balance sheet, and your accruals will be grouped under your trade payables and will be presented in the unbilled column of your trade payables aging. I hope you found this insightful. Thank you so much, guys. Keep learning, keep growing. Thank you.